Okay, welcome everyone. Thanks again for joining us. And we're really excited today to have Dawn Levis from Gruene Insurance Group. And the reason why I'm so excited is that Dawn is very knowledgeable in everything that I want her to be knowledgeable about. And so, me being a dummy, I ask a lot of questions. And so, she handles all the insurance and the Medicare aspect of all the complexities, but she also handles the financial services that you require as you get older. So, we get two for the price of one. So, without further ado, welcome, Dawn.
Thank you.
Excited.
I appreciate it, Dr. Pack. You know, we love doing partnerships with you guys.
Yeah.
You guys have been a partner of us for many years, and we appreciate that you are back.
Mhm.
And we are super excited. Most of my clients that I talk to, they're like, when can I get in? So I'm sending Amy texts all the time. So
That's
thank you for that.
Thank you for that plug. I appreciate it. We love it. So one of the things that questions I get all the time from patients, and I'm sure you hear this all the time, is what is the difference between Medicare and Medicaid? They ask that all the time.
So I love that. I have a great answer for that.
Yeah.
Medicare is federal because the federal government has to care for you. You've paid in for that for year after year. That's your Part A portion. Medicaid is state level. So that's where the state steps in to take in the gaps of where it is if you're at a certain income level. So when you get those commercials on the TV and it's, Joe Namath saying, hey, come get this plan, chances are I get this call probably every day, if not twice.
Yeah.
How do I get those grocery benefits? And I ask them the same thing. Are you ready to give up your pension to get that? No, then you don't get those grocery benefits because that's a CAID benefit, not a care benefit.
Thank you for explaining that. And then, there's Medicare is so complicated, right?
Yes.
With all the different things. So there's a part A, B, C, D, E. And it's like, pretty soon I think it's going to go to Z. What do you think? It's going to go to Z?
I call it the alphabet all the time. Alphabet soup.
I know. So for us Medicare dummies like me, can you explain to them all the different parts of Medicare, please? That'd be great.
Yeah. So A, like I mentioned, it goes with your Medicare, and that is the portion you've been paying in your whole life. So that's hospitalization. That's your guaranteed portion. B is your doctor's visits. That's what pays Dr. Pack when you come into that, when you're on original Medicare. And A and B, that gives you, it's an 80-20. What does that mean? That means 80% is covered by insurance, 20% is covered by the client themselves. Then you add, they talk about C. That's a Medicare Advantage plan. So they renamed it into that, and you can get it with or without drugs. Then if you add a D, that's drugs. So you can get a Medicare Advantage plan with drugs or separate. And then you get into the other alphabet, which is your E, F, G, all those are supplemental, and they're a whole different realm because many people like a level playing field when it comes to Medicare. So what happens is most clients now, if you were born or if you turn 65 after 2020, you get a G or an N, which covers the 20% that B doesn't cover. And then they have variations in and out from there.
Oh, that was such a great explanation. And as you know, all my clients complain their mailbox gets full of all these Medicare Advantage things, especially around the annual enrollment plan,
yes.
AEP they call it. It's a big one. So can you explain the timing of that, what that means?
Yeah. So AEP is your annual enrollment period. It gives you the option to make a change. So maybe you're on an Advantage plan and say you're on WellCare, and you decide, hey, I want to move to WellPoint. You have the opportunity to make a change. Think of it like when you were working and you had your group open enrollment every year, and you can go switch it. I refer an Advantage plan to group all the time because it's exactly what it is, and you have that enrollment period. Then from January to March, you have open enrollment period. What does that mean? Say you joined WellPoint and you're like, I just don't like it. I want to go back to WellCare, or I want to try United Healthcare. You have one time between January and March to make a change that says you can go into that. The rest of the year, they have what's called as an SEP, special enrollment period. So say you're working with you, Dr. Pack, and you find out this client has severe diabetes, and we put them they're on an Advantage plan with United Healthcare, and there's a chronic issue that's coming up, and there's certain medications and different things. We can use a special enrollment period to switch them to one of those plans because you're saying, hey, you need more assistance to be able to get that. And then, to your point, talking about Medicare and Medicaid, say something happens and you end up on Medicaid, then you have what's called a DSNP, which is a disability plus your Medicare, and there's a whole realm that you can move within that special enrollment period because that's happened with them.
So as you can imagine how complicated this is. I'm just like, whoa, I don't know about you.
Yes.
So what I tell my patients all the time when they have questions, I really refer people just like you, who's extremely knowledgeable, and I encourage all patients when it's time for their Medicare and they have to kind of choose, really go with someone like Dawn with Gruene Insurance Group, because they can really match your plan, what your needs are, and custom make it. It just really makes all the difference. And trying to navigate this barrage of just craziness is just very, very difficult. So one of the things I learned is that find a really good, trusted, ethical broker with integrity like Dawn. I highly recommend during that time to reach out. So another question I get often from most of the time is from family members. Is that we have they're trying to figure out how to get their grandparents or parents into a nursing home.
Oh.
And I said, well, it's not as they all, I don't know why, but they all think if they have Medicare they can get into a nursing home, and that's not true. So can you kind of explain that?
So to get into a nursing home, there's only 2 ways to pay for that. Truthfully, well, 3. Cash. So if you have cash that's put aside, and it's anywhere from $6,000 to $12,000 a month. Long-term care. Long-term care is a huge opportunity. Only 8% of the population have long-term care to pay for that. Or Medicaid. About 65% of all nursing homes is paid through Medicaid. But to get that, you have to qualify for Medicaid, and it's considered a federal poverty level, so you have to be 400% under. And there's a guideline that the government has, this beautiful little magic number that they come with every year that comes up with that. Plus, there's a lot of things you can't do. You can't have more than $5,000 into your checking account, $5,000 period cash, and that includes cash value life insurance. What if you own a home? If you own a home, the chances are you can't do that. And then what happens is they're like, oh, well, we can do that. I'll put it in my kid's name. They have a 5-year look back, Dr. Pack. So they're looking at some of those things. So if some of that comes up, there's a lot of different scenarios. So when we work with seniors, that's why majority of the people that we do, we're not just looking at their medical, we're looking at their financial wealth and health, because sometimes you're having to look further in on things that are going on. So just to jump into that, it is not that easy of just saying, hey, let me just sign that house over, or let me cash out my cash value life insurance. We have scenarios all the way along to be able to help keep a lot of that and preserve that, to be able to help keep your family intact as well when we speak.
Yeah, so as we kind of go into the financial planning part, I think what I always tell patients, you really need to get a pretty good idea of what you think, because everyone's always focused on their portfolio, their IRA, and then the magic number of 4% withdrawal rate and all that stuff. But I always tell them, there's so many expenses that you don't kind of think about.
Yep.
And one of them is what you mentioned, is long-term care insurance.
Yes, sir.
So it's highly underutilized, as you mentioned, but I think you said about 8% of the population actually have that.
Correct.
So can you explain what that is and how that differs from Medicare and Medicaid and all that? Yeah.
So what happens is most people, so Medicare, let's talk about that for a second and how it plays into it. Your Medicare is medical, right? But what typically you need is when mom gets older is somebody to cook for her, somebody to clean for her, somebody to take her back and forth to doctor's visits, right? And there's that sandwich generation, which is where I'm at, that, the 50-something, where we're having to do that, plus still raise our kids and somehow think about our own retirement, right? So long-term care does just that. They have a thing that's called an ADL, and I'm sure you're familiar, which is active daily living. So if you're meeting with Dr. Pack and all of a sudden some issues come up, maybe that they're having a hard time dressing themselves, maybe they're having a hard time feeding themselves, toileting, whatever it is, or cognitive is instant. So it could be, Alzheimer's, even dementia. So that's something that calls that on, that says now that money can be used to pay for that. It used to be you had to go into a nursing home, but they have evolved, right? And so you can literally use it to pay for the costs for somebody to come in your house, to do all those things that are needed for that. And so when I work with clients, especially when they're first retiring, I talk about it all the time, because now there's so many hybrid options that says, hey, let's look at these things. Do you, and I'm pretty frank, I'll be like, do you want your kids wiping your butt later? And they're like, well, no. And I'm like, we need to have this conversation.
I'm so glad you're frank about it. It is a hard discussion to have.
Yes,
nobody ever really thinks about it. So just for clarification, so if you do have long-term care insurance, that's not only for a facility, it actually will pay for a caregiver to come to
Yes,
your
sir.
home. Because a lot of, as you know, a lot of patients or elderly, they want to stay in their home as long as possible.
Yep.
So that's a really good option for them.
Yep. Had a client just the other day, I was working with that. And I work with a lot of the facilities around here too, ones
Right.
that I know that are ethical. And I look at their long-term care policies and I'll be like, hey, so I had this really sweet little 88-year-old lady who has onset dementia, took her car away. She was really upset. She has this beautiful home and does not want to leave. Her policy is an anomaly. She only had a 7-day wait. What does that mean? That means Dr. Pack says, okay, I gave this diagnosis. Yes, this is the issue. For 7 days, her plan, they had to pay for it cash. And afterwards, the policy picked up and was paying for that caregiver to come in 5 days a week. So then the family could come in on the weekends to help take her grocery shopping, to keep her independent, stay in her house. She sleeps overnight, so she does okay with that. But it's during the day because she's had a lot of people try and take advantage of her because her cognitive is
Yeah.
But majority, it's a 90-day. So that's the tough part. So that means for 90 days, when we talk about finances, you need to be able to have that money put away to pay for that. And what happens once that 90th day comes up, you'll get some of it reimbursed, but then that money picks up and it's covering that. So you've got to be able to have at least 90 days worth of money put aside. And you mentioned it earlier, a lot of people just don't plan very well and they don't think of it because they think Medicare is going to cover it, and it doesn't.
Right, I appreciate that. I think that's a really important point, to know what Medicare covers and all that other stuff. And then, you know, a lot of my clients who are, you know, pretty well set, you know, and they actually have portfolios, and they're shocked by something called IRMA.
Oh,
And they're like,
yes.
what is this? How come no one told me about IRMA? So can you explain what IRMA is?
Absolutely.
Yeah.
She is not your friend. And so
That's what they said too. They had a different word than
yeah. They called her something like a witch, right? You know, and so but here's the thing about IRMA. So what the government does is they say, hey, for your Medicare, that Part B that you were referring to, and D for drugs, they say, okay, you've done well for yourself. We're going to charge you more for your medical costs. So they have realms each year. So when I do presentations about Medicare 101s and I have those discussion, I talk about IRMA all the time. And that's exactly how I start. She is not your friend. Okay, and you need to know about it. So that way when you're planning 5 years before, most people are thinking, oh, I've got plenty of money. And they go in and their Medicare costs, instead of being $202, which is the standard cost right now, they're paying between $500 and $700 a person. And they're like, but my wife, here's a prime example. She's been a stay-at-home wife. I understand, but she has your money. You've taken good care of her. So now not only are you paying $700 for you, Dr. Peck, but you're also paying for Christy. So that's $1,400. And they're like, well, I thought it was going to be cheaper to go to Medicare. No, IRMA has made it not so nice. And they charge you for that. But they're like, well, when I retire, I'm not going to be making that. I understand, but they look 2 years back. So they're going 2 years back for yourself to look at that. And another thing that pops up too is they're like, well, I sold my house, I downsized, I'm going to use this money, I'm going to put it in a product, so I have that. But they got hit for that for 2 years, even though their income, they might be living on, you know, $3,500 or whatever, and that's not the same. They're still having to do that. So when you're thinking about retirement and you're thinking about Medicare and you're thinking about that whole thing, you need to start 5 years before you're ready to retire, so you know where the numbers are altogether. I get the call for Miss Irma, who is not your friend, all the time.
Yeah, the more you get educated, the better. There's so many different pitfalls that you can fall into.
Yes, sir.
That's why it's really important to have a financial planner you can actually sit down and talk with. And then also, I have clients that just project with their 401k or especially their IRA. They feel like they can just keep it in there tax-free as long as they have forever and ever and ever. And they don't realize that the government's not that dumb. And they have this thing called minimum distribution that you have to withdraw.
An RMD, required. The key word is required minimum distribution. It was just before I came in here having that conversation with a client right now. So what they say is, we've given you these pre-tax dollars all this time. You put it in your 401k, an IRA, simple SEP, whatever you put it in, right? And they let it grow the whole time tax-free, but they have to pay the Pied Piper. So what happens at 73 and a half, you have to start taking a percentage, regardless if you need it or not. And what happens is you need to have a scenario of what's happening. So I was meeting with a client today. He's significantly older than his wife, right? And he's trying to plan for her. So you want to have somebody that's allowing you to be able to plan where you're doing with that money, how to keep your tax base a certain way. So having scenarios where you're taking, like for this client, we're taking their RMD, we're turning around and they've paid taxes on it now, and we're creating a tax-free product. So if something happens to him, his wife gets that money and she'll be able to keep using it and creating that. But yes, required minimum distribution is very, very important. And then here's the craziest part. If you don't take it, they tax you and fine you for not taking that required minimum distribution. So for example, if you had to take $5,000 in your required minimum distribution, you didn't, they're gonna tax you around $2,500 as a penalty for not taking your money and paying taxes on it. It's about 50% of what it is.
I tell you, they always find a way to get your money. Isn't that the truth? I'm so glad you're here to explain all that. As you can imagine, it's so complicated. And you know, again, don't try to do this on your own.
Oh my gosh,
if you don't really rely upon somebody like Dawn to get some good advice. With all the years of experience you've had, what would you say is the number one mistake that most people make in planning for their future and their retirement?
They try and wing it. They think they're going to have enough money. I think the number one thing that I see that people do, they think Social Security is enough. Okay. And it really is a three-legged stool, in my opinion, if not four, right? So that's the key thing that it comes through. I think you need one, yes, Social Security is one. Two, personal savings. Three, I do think you need to, if a company offers you a 401k, some sort of product, put it into whatever their match is. And four, you need to have some sort of tax-free product that's out there that's allowing you to have money later. Because what happens, here's another thing that I see. Oh, Dr. Pack, I finally retired and I'm going to take money and I'm going to pay my house out and I'm taking it out of my 401k. They're inflated their income. So now they went from like a 22 or a 24% tax rate. Now they're in a 32. Don't understand why they got hit with such a high tax rate. It's my money. Why do I have to pay that? Well, because it was a pre-tax product. So having that four-legged stool to know where that's the case and having plans. I always say if you think you're going to retire at 65, you need to be starting to talk to somebody at 60. Let's talk about IRMA. Let's talk about when you're going to start taking your retirement out of your portfolio. What do you have in the market? What do you have that's safe? I think everybody needs a safe amount of money. In retirement, inflation's going to eat it. So if you're not constantly thinking about having that guaranteed income stream, I have people tell you all the time, I'm like, okay, the average Social Security payment is $1,600. That's average. Who can live on $1,600? And if it's two people, okay, $3,200, maybe that's okay. But what happens if that one passes away? Where does that person go? Are they moving in with you? Are they moving in with your kids? Who's taking care of that person? So there's so many scenarios. So the number one mistake is they're winging it. Period.
So they don't have a very specific plan and strategy. That's a big problem.
Big problem. And Gen Xers are worse. Baby boomers, they were had a different scenario. They were very much pigeonholers. That's what I call them. They were squirreling money here, squirreling money there. Gen Xers are like, for lack of better words, we'll figure it out when we get there. And that wasn't really the words I wanted to use, but yeah, you know what I'm saying, right? And they're just like, hey, okay, I only live once, right? I'm gonna have it. And at the end of their rope, what are you doing? You're having to sell your house to do that, or they're having to move in with their kids, or they're having to work. How often do you go right now to McDonald's or Walmart and there's a 73, 74-year-old person still having to work because they need to pay the bills? I literally had a lady come into my office the other day. Her and her son were gonna buy a home together. The son passed away way early. He was in his 40s. They bought a house together and she's having to pay an $1,800 house payment and she's 69. She was thinking her son, So I'm like, you need somebody to come rent a room or you need to sell that house. But she has no equity. She's only had it a year. So there's things like that. You see Amy's face going, right? But that's exactly what happens because people don't know,
right?
And it's very heart-wrenching because you want to help them, but there's only so much a person can do.
Right. So I think the moral of the story is you can never start too early and don't try to wing it. Really financially plan out. Another big thing I think people forget is age. They don't realize that, my patient comes to me a lot and I said, wait a minute, according to, statistics and blah, 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 I only have a couple of years to live. And I said, how old are you? I'm like 82. I said, No, that's not right. They don't realize that the older you live, the older you live.
Mm-hmm.
And so you really have to understand the statistics is that, that is just in general. But every single year that you live longer, your life expectancy grows. So you don't want to outlive your money. And so my recommendation highly is to find someone like Dawn and talk with her, and she can go through all the variety of products. And so I think she can make your life a lot easier and plan it out. So again, I can't thank you enough. You've been phenomenal. I think we're going to have to do a second portion because there's so many other things that we want to do. But I really hope we can get you to come back.
Please,
and talk
I love
more
the invite.
about it. Just
Yeah.
invaluable information.
Mm-hmm.
And I would highly recommend you guys tape this podcast and rerun it many times, because I know I have to, just to go through everything what she just learned. Just a wealth of information. So again, thanks Dawn from
Yes.
Gruene Insurance Group.
Awesome. We appreciate it. Thank you.
Thank you.